Pete Rose is here, financial coach. Today, I want to talk to you about building long-term wealth. Now, in my opinion, there's two ways to build wealth. One is through real estate. The other is through the stock market. Sure, you can, make good income, build a business even, but essentially, what you need to do with that income that from either your job or business is you have to invest it. And the two investments that I know that build wealth are real estate and the stock market. So I want to talk to you about a little bit about real estate. I'm not a real estate expert. I'm not a real estate. That's the real estate is not part of my large plan to build wealth. So I can't advise too much on there, but I'll share with what the reason why I don't invest in real estate and why I decided to build wealth through the stock market. So with real estate, I have plenty of clients who built real wealth in real estate, done really well, and more than likely, if you're building wealth in real estate, you're not investing in the stock market. And the reason why is there's a couple of reasons that I've seen. Number one, you just don't understand the stock market, and real estate is tangible. You can feel it. You can walk into it. You can knock on the door, right? You can rub the floor, rub the walls, and feel it. With the stock market, it's an intangible investment. I mean, sure, you can have a stock certificate, but it's a piece of paper, and most people that don't understand the stock market look at it as risk or gamble, or they just don't understand it enough to invest into it. So they invest only in real estate. So the clients that I've seen build wealth in real estate really don't have a strong stock portfolio or investments in the stock market or invested even at all in the stock market. They're really focused on building that business, that empire, which requires constant cash to invest into new properties. And if you think about an investment property, if you're purchasing an investment property that you're not moving into, typically it requires 20% down. So that down payment, on a $400,000 home, which if you're buying a multi-unit home in this area where I live in New Jersey, you're probably talking about four, five, 600,000. So on 400,000, that's $80,000. So you need to have at least 80,000 plus closing costs. So we can add another 10 or $20,000 there. So essentially, you need $100,000 to buy a $400,000 house. Now, the way to do this, and the way I've seen my clients and very successful people do this is by purchasing a multi-family house, but moving into the house. So you can essentially move into that house. And let's say that's your first house and you buy a multi-family. If you're looking to build wealth with real estate, you should buy a multi-unit house and move into it, right? The first one you buy. You move in there and then you have a tenant. You collect rent for a couple of years or however long you want. You build up cash and save for the next purchase. Now, the next purchase that was 3.5% down. The next purchase it'll be a multi-family house, and that you can buy an FHA 3.5% down. You move into that one. So now you have the one house that you originally purchased. You have two units there, or two, three units, and you have rental income that's paying for the mortgage and then some. And now you have a two-family house that you purchased that you moved into, and that is also you're collecting rent from the people upstairs as well. And then eventually a couple years later you start saving up, you start collecting rent over time. You buy your third house. The third house could be the one family house that your dream home, something that you really want to live in with your family. Now you have kids. Essentially you want to have your own place, your own yard, privacy, not have to deal with anyone upstairs running around with the kids or dealing with tenants in your own home. And now you have three properties. You have the one that you originally bought, two family, three family house. You have the second house, could be two or three family house, and now you have your own house that you purchased 3.5% down. So this kind of method, allows you to purchase real estate without having to put so much down, where you can purchase it at FHA legally, and there's nothing wrong with that, and you can do that. So that's one approach you can do there. If you buy a one family house in the beginning and then say, hey, I want to buy investment properties, it's very hard for the bank or FHA to justify why are you moving from a one family to a two family, right? And then if you violate that, then it's very difficult to get a second FHA loan, and you kind of burn that bridge there. But essentially, you want to do things right, right? So we want to do things right, want to do things legally. So if that's your goal, purchasing real estate, go ahead and do it. That's one way to do it. And then ultimately, as you have these investments pay you and you build wealth and build investments and you build up your cash liquidity, you can continue to buy other properties, multi-unit properties, apartment buildings, and then grow that empire that way. So that's one way to do that over time, and then that kind of builds up over and creates its own momentum based on you reinvesting the rental income, right? Taking paying out obviously the mortgage, the expenses of the property, and then reinvesting that over into new real estate. And then over time that will build up, right? So retirement comes, you have at least three homes. Let's say they're all worth $1 million each. You have $3 million. You can access that, or you can just live for the rest of your life on the income from the properties if that's enough to sustain your lifestyle. So a few things that I don't like about real estate is that in order for me to access the equity in my home, I need to either sell the house, refinance the house, or take a home equity line of credit, also known as HELOC, right? So sell the house, refinance the house, take a line of credit. That's really the only three ways I can access. The other way is a reverse mortgage, which you can actually borrow against your equity over time, and that's another way too. So essentially, in order for me to access my equity, I always have to pay a fee. Either I'm paying a realtor to sell my house, or I'm paying fees to refinance my house, or I'm paying interest to the bank to borrow against it, or I'm paying interest against the bank to do the reverse mortgage and have them pay me through the equity that I have. Essentially, the equity is dwindled down over time until there's no equity left in the home. Right. So those are a couple ways to access it. I just don't like the fact that I have to pay for it. Right. I have to pay to access that. So if you're okay with that, that's fine. So for me, I do own my home. I know that my equity will build up over time, but I'm not depending on that to really build wealth and for me to sustain my lifestyle for the rest of my life. Right. If I work till 65 and I live to 90, which is likely to happen, I may die sooner, who knows? But I'm likely to live to 90, and that could be another 30 years in retirement, right? 25, 30 years in retirement. So if I need $100,000 a year to sustain my lifestyle when I'm 65, and I'm using that over time, then that money can go in 10 years. It's $1 million, right? So think about how fast that money can go, and really the amount of money you need to build over time. So I do own my house. Eventually, I'll have I do have equity. Eventually, I'll sell it maybe, or and my kids will inherit that, and that'll be part of my legacy. But I'm not depending on my house alone, and I have really no interest in being a landlord. I know that you can hire a property manager to take care of things, but this time I own a one family house. For me to buy an investment property, I need 20% down, and I'm reinvesting my money in other ways. So I really don't have. It doesn't make sense for me to build 80, $100,000 in cash where I can invest that in other areas. So this part of the video is really just talking about what to do. So I think a lot of people have this kind of like sense that the only way to build wealth is to buy real estate, and the only way to be successful is to buy real estate. And they're kind of stuck on this thing where if they don't buy a house, I'm not successful. Ultimately, some people just buy a house when they're not ready, and they just kind of like put themselves in a position where their mortgage broke, or they're just not like doing things right. So they may lose the house because they just weren't ready. But when you buy a house, it's a liability unless someone else is paying that mortgage. It's a liability, and it's really not an investment right away, right? It's more of a liability, and in which a long term turns into an asset. So I'm not against buying houses, but what I would say is that those of you that think that's the only way to build wealth, I want to talk to you about that now, right? So a lot of people force themselves into buying when they're not ready, or just another thing is that the bank will always give you more than what you need. So if you're borrowing what the pre-approval is from your loan officer, 100% of that, more than likely that's a lot too much for you to take on. You should, rule of thumb, try to stay with around 25 to 30% of your income, right? And that's assuming you have no debt. So the first step is to really put yourself in position to buy a house. If you want, make sure you have enough liquidity and make sure you have enough reserves to cover any expenses. So if you're not going to build wealth in real estate, how else can you do it? I mentioned that in the beginning, stock market. When people think of the stock market, they think about, it's, they look at it more of a gamble because they really don't understand the stock market, right? And I'm a strong believer that you should not invest into anything that you don't understand. So if you really don't understand the stock market, don't play around with it, right? I mean, unless you're looking to kind of as an excitement, put 1,000 here and see what happens, but that's not really a sure way to build wealth long term, right? You really want to be understanding what you're doing, investing over time, and having a strategy, not just kind of shoot from the hip strategy, is really a long term play and know what you're doing. So I want to talk to you about how I invest and how my plan to build wealth. And I'll bring up the whiteboard real quick to kind of write that out because I think it'll be easier to understand if I kind of scribble it out. So there's what stock is. So if we look at what a stock could be, is a company, a publicly traded company, and they own, they have shares that they sell, right? So you look at McDonald's, look at Home Depot, look at Sony, you look at Toyota, you look at Amazon, the big, four, your Google, and you have, let's say Facebook, right? So these are all publicly traded companies, well known. We all know, who these are, and who they are. Now these companies, they're publicly traded, so they all have the ability to sell their stock, right? And you and I can buy into the stock. You and I can buy into McDonald's, Home Depot, and we can, whatever the price per stock is what we're going to pay for it. So if McDonald's is, $50 per share, we're buying into McDonald's. As far as like, now you're part owner of McDonald's. Now, very small share, very small percentage ownership, but it's really, you're buying the stock. Now, if the stock price per share goes up, means that the company's doing well, you make money, right? If they go down and they're not doing well, earnings are not great, they're really not growing the business as planned and expected, you lose money. So this price per share will go up and down based on the performance of the company, right? And this may go up to 60, 100, may go down to 20. So really, this is really essential way to, essentially how you would buy into stock is buying individual stocks. And there's different platforms where you can buy stock, and you can do this. This is not what I do, and I'm just explaining this to share the next thing or what I do. So if I could, let me just erase this all. And what I do is what's called a mutual fund. All right, this is what I invest, and this is my plan. I plan to invest over time into a mutual fund, that will build wealth over time. Now, what a mutual fund is, it's a fund that is mutually funded by multiple investors, right? So we have multiple investors investing into this mutual fund, and they're dumping cash into a pool that is shared and mutually funded. Think of it as, we all collectively put, $1,000. Now that $1,000 is put in a bucket, and this circle right here represents the bucket, right? Now, all this is really stocks, right? This is pretty much a fund that is invested into stocks. So you'll have a mutual fund manager, right? And this mutual fund manager, right, this person right here, is going to decide where the money goes. And ultimately, it is broken up into different categories of what type of investment. So there's a growth in income, which is a blend of stocks and bonds. Bonds is pretty much just debt. So if you look at municipal bonds, municipal bonds will be, your town, the municipality. I live in Fair Lawn, so the municipality of Fair Lawn needs to repair their bridge. they don't have $1 million to repair the bridge. So essentially what they'll do is they'll borrow money from a bond, which is called a bond. And essentially what they'll do is the taxpayer dollars will pay for this bridge over time, but you're invested into this bond, so you reap some of the benefits of lending that money. So the bond fund on this side is another pool of money where it's lent out to different, as debt. And then these municipalities, let's say for a municipal bond, will pay back plus interest, and then you reap the benefit from that interest, right? So bonds are, they're not as rewarding as stock. You're never gonna, earn, 30-40% interest over, in any given day, or, but at the same time, you're never gonna lose 30 or 40%. So relatively a safer way to invest. And the growth and income mutual fund, there has a blend of stock and bonds. So you have the individual stocks, as we mentioned, like McDonald's, Coca-Cola, Pepsi, Home Depot. And then you have the bond funds that have a different approach where it's really debt that you're benefiting from. Then there's a growth stock, growth mutual fund. The concept there is that with growth mutual funds, it's really all stock, and it's stocks that are above average in growth, so a little more risk there because there's no bond exposure. Then you have aggressive growth funds, which focusing on companies that are growing rapidly. So there's a little more risk there because obviously these small these companies that are growing rapidly can also lose, or they can that can turn negative rapidly as well. So a lot more volatility in an aggressive growth fund because you're taking more risk in these stock companies. And then you have international stocks. International mutual funds, which are invested in international stocks like Samsung, Nestle, Toyota, L'Oreal, Volkswagen, Unilever, Sony, and international companies like that, where they're companies that are outside of US but sell a product in the US as well, or all over the world. So these mutual funds have different objectives. Some are more aggressive, some are more conservative, some are moderate, right? So you get to choose which type of mutual fund you want to invest in. And in this situation, in general, all mutual funds essentially work the same. So you have the pool of stocks, you have a pool of investors that mutually fund this investment, and the manager decides which stocks are we going to purchase? Home Depot, McDonald's, we have Sony, we have Pfizer, we have Amazon, we have Facebook, and then we have all sorts of companies, Nike, right? And international, maybe Unilever, right? Procter and Gamble. So, and typical mutual fund will have 50 to 150 stocks in this mutual fund. Now, what that does for you is, and why I like mutual funds, is that all this does is diversify. You've heard the word diversify before, maybe you're not, but it diversifies the risk. It's like, instead of putting all my eggs into one basket, which would be McDonald's, let's say, if I put all my money in here and this one company, McDonald's, doesn't do good this year, or they fail, or they go bankrupt, right? All my eggs are in one basket and the risk is really high. However, when I spread that risk over 50 to 150 companies, I'm diversifying my portfolio. And it's a fancy word of just kind of spreading it out. So instead of buying individual stocks, I'm buying 50 to 100. And the beauty of this is you can start with $50 a month or something like that. Some companies require a large investment, but if you're on a budget and you can only put $50, you can certainly find mutual funds that'll take $50 per month. It won't grow and build wealth at the rate that you probably need, but if you need to start, that's a good way to start. And you can put as much or as little as you want into a mutual fund. So essentially, this is how a mutual fund works. And this is my strategy I'm building. So the average, the rate of return on a mutual fund over time, I've seen greater than 12% of mine, but I would say on average, you're looking at 10 to 12% on a diversified fund that has a mix of aggressive growth and some growth and income funds, some international funds, and some some growth funds. So you have that mix of different types of investments. Um, you need to, if you don't know how to pick your mutual funds, you certainly should speak with a financial advisor, someone that's licensed and that has experience that can help you. So that's a good way to start. And over time, this will build. So I want to, as we clear this out, I want to show you some examples of what this will look like over time. And I'll share a different screen here. So if we look at this screen over here, this screen shows you, let's say for example, you have, hold on, let me share the right screen here. All right, here we go. So this screen right here will show you, this is an investment calculator. You can pull this up anywhere. This is calculator.net, the website. So you can even Google investment calculator, and there's tons of different investment calculators that you can use. They all work the same, and they all spit out the same numbers. So I put an example of someone that's 25. Let's say you're 25 years old right now, and you're just starting. You put $100 in, and then you're putting $200 in every month. You're averaging 12%. And over time, that's going to be from age 25 to 65. That's $2.3 million, right? So if I'm half right and this person has $1.1 million, um, you know, I'm sure that person's not mad at me, right? So, you can look at this and say, hey, I don't really believe that 12% is achievable. If it's not, then, and again, if I'm half right, and you have $1 million, I'm sure you're not mad at me. So in your situation, maybe you're not 25, right? Let's say you start at 35. Look at the difference by putting $200 away if you just waited 10 years. So we started a little later. So now we only have 30 years left. And let's see what the difference is. The difference is $1.3 million, right? You had two point something million, $2.3 million. Actually, it's $1.6 million difference from just waiting 10 years. Now at this point, you really have to catch up. Even if you put 400, which is double, you can see that you're still not close to that 2.3, and you're almost $1 million off. So starting early and time in is key to the investment and investing into mutual funds. This is not an overnight investment. It's not like this sexy stock that'll double and triple overnight, but this is a sure way to build wealth over time, right? And obviously these rates are not guaranteed. It's based on past performance, but if you look, we what we say in this field is past performance predicts future results. Not 100% of the time, but if you spread the risk out and you select the right mutual funds, and you look at past performance on a mutual fund to see how they've done, it can almost predict what you should expect, right? And again, if you do half as bad, you're still not in a bad place. So let's say you're 45 years old, right? And you're like, man, I really didn't start. And I thought I would build wealth, but I mean, this all sounds interesting, but I need to really get going. So the fastest way, so your number one wealth building tool is your income, right? And what you do with that income will determine how you build wealth. And if you look at your debt situation and you have debt, the first thing I would say is, hey, get rid of your debt, right? Work on being debt free, put together a budget, stick to that budget, and pay off that debt. Work part-time jobs if you need to pay off that debt, because the sooner you pay off debt, the sooner you can free up money to essentially put back into your retirement, right? Or your investments. And what I would suggest you to do is get to a place where you can be debt free, including your car. So if you think about it, you have two car payments, that's, that could be $800 a month, or anywhere $600 to $800 a month. If you have some credit card debt or loans, get rid of that. That's a couple $100 there, or $1,000 or more. So let's say you became debt free and you're able to put $1,000 away, and $1,000 away a month, and you only have 20 years, right? Because you're 45. You still can be a millionaire, right? You can still build up $1 million in 20 years. even if you started late. Obviously, if you started sooner, even if you put that, look, if you started at 35, putting $1,000 away, you're in a lot better position, right? 3.5 million. But if you're playing catch up and this is all you can do, there you go. Now, let's say you're in a position where you can put more, and you have $1,500 here you could put. Now you're putting yourself in a position to really have 1.5 million. So these are just some ways to build wealth. This is my strategy on building wealth. Now, this is a mutual fund, and now you can do this through your 401k. So if you have a 401k at work and they match, that's a really great way to take advantage of your employer investing into your retirement. You can if you have a matching, they match 5% or 3%, whatever. It's free money. So essentially, it's more money they're investing into your retirement, and the longer you're there, the longer they incentivize you, and and you can build wealth through your 401k and become a millionaire. That's what your goal and passion is, and what you need to do. So, um, just to kind of like end this, I really I heard a story by Dave Ramsey. He talks about a book that I think a lot of us are familiar with, and it's called the Tortoise and the Hare. And if you read the book, which I'm sure you've either heard of it or read it, and if you're not, just pick it up. It's a short read, and it's actually a toddler's read, like a child's book, but there's some really good truths in that book. And you think about the story, you have the tortoise and the hare, and obviously the hare is faster, and they're racing, right? So they decide they want to race to the finish line. Obviously, the tortoise is a lot faster. He's stronger, more athletic, faster, right? And he can for sure beat this tortoise. But what happens in the book is that the tortoise is overconfident. He knows he can beat him, and he's really attracted on just kind of, just going fast and just kind of taking breaks. And it's a long journey and it's a long race. And this hare gets distracted. He stops here, gets lunch. He hangs out here, does this. He's playing around, not really doing what he has to do. And the tortoise is just pushing along pushing along. He's, steady at it. He's not taking breaks. He's not being distracted. He's got his blinders on, and he's really focused on the finish line. So, if you all know, the tortoise wins, and the tortoise wins because of what I mentioned. He was just kind of steady on it. He was on pace, and he didn't give up, and he just kind of stayed on his course, on his plan. While the hare was just kind of looking for excitement. He was looking how to do things easier and how could you do things faster, right? Really not really. If the hare would have just kind of stayed on pace with the race, he would have won. But what I take from that story is that a lot of us are attracted by certain stocks. We see a stock and we see, wow, you can double triple your money. Very few people understand the stock market enough to buy individual stocks. They're really looking for, or they're looking for a shortcut, right? How do I make maximize my income by making these investments? And then what they're seeing is that they can double triple their money, and then now that's a way to build wealth. The hare example would be a mutual fund. It's really not exciting at first. You don't see a lot of growth, but if we look at this example again on how this built up over time, in the very beginning years, we're not seeing a lot of growth here in the beginning. I mean, it's really like the blue line, is the total contribution, what you're putting in. I'm sorry, the darker line. The blue line is the starting amount, so the $100 and how that grew. But the green is the interest, right? And you're not seeing at look, the first 5 years is it's really not there's not much of a difference between the interest and what you put in. But 10 years, you kind of see there's a spread here. 15 years, you see, wow, this thing is working. And then look, in 20 years, you're seeing that your total contributions were 360,000, right? That's what you put in. But your interest, because it compounded over time, something called compounding interest, that is your interest making interest. Because the first year, you've made a certain percentage, but now your interest is earning interest and it's compounding out at a rate that is just exploding. So this approach is slow and steady, right? This is the hare approach. I'm sorry, the tortoise approach. That's why it's green. And the hare is just kind of all over the place, like the stock market. It's up and down, up and down, up and down, up and down. At the end of the day, I feel I sleep better at night knowing that I'm taking this step. That it's steady, it's slow, but essentially it's a plan to do it. And I'm seeing the rewards now because I've been doing this over a long period of time. But you need to stay at it consistently, get out of debt, have enough liquidity for emergencies, put at least 15% of your income into your retirement, 401k, IRA, whatever you need to do. Meet with a financial advisor to kind of just see what you're doing, get his advice. And this is a way to build wealth long term by buying into stocks, which is essentially buying stocks through mutual funds, long term, slow and steady, and you'll get there. And now, if you choose to do real estate, I'm not mad at you. It's just not my approach. And there's nothing wrong with building wealth in real estate. But if you didn't know you can build wealth in stock and you didn't really understand it too well, I hope this video helped. If you like this video and like to be alerted next time I post my next video, please like it and please subscribe. And I'm happy to continue to provide these videos to help you get closer to your goals. Till then, make it a great day.